Stress test for mutual funds? Well, that is what the SEC apparently is considering. This according to a front page story in today's Wall Street Journal. The commission says the paper is potentially developing reporting requirements and other procedures to determine how mutual and hedge funds would weather dramatic jolts to the financial system, such as a sudden large move in interest rates. Brian Reed, chief economist at the mutual fund industry's main trade group, the Investment Company Institute, joins us now. Brian, welcome back. Good to have you with us. It seems to me that what the SEC may be most concerned about are derivatives and the leverage that they can bring into either mutual fund portfolios or into exchange-traded funds that are sometimes double and triple levered to the benchmark that they are trying to follow. How dangerous is the use of these derivatives and that leverage in the context of a mutual fund?
So mutual funds and ETFs both have the same sets of rules, and the SEC has had rules in place for many years on limiting that amount of leverage, as you say, in these funds. We don't really know what the SEC is specifically considering, but their focus is on protecting investors and making sure that those investor protections also, the funds operate well and provide financial stability. And so what we're understanding is that they're looking at these and have been looking at these rules for some time.
So you don't really know just yet, Brian, what these rules will entail, but from what you do know, so these are going to protect investors, but to what extent is there a cost tied to it? With all the new compliance, the stress tests and all of that sort of stuff, will there be new fees and new costs to individual investors? And how might these changes also impact performance of the mutual fund?
It's hard to know what the rules are considering. One of the things that derivatives can do that often are overlooked is actually help reduce risk in funds as well. And so the SEC is going to presumably be looking at all of these, the positive features of derivatives, as well as the rules that they have in place as to the extent that they can maybe carve those back or limit those if they believe that they need to be updated. But again, the key part here is the SEC has an open process. They look at the rules, they look at what they're proposing, as well as the costs and the cost of implementing. And then they have an open process for commenting. So investors, mutual fund advisors, and the ICI can all weigh in and provide input into that process.
As I understand it, Brian, without getting too Washington insider here, you and the ICI, not you personally, but the ICI, is happier having the Securities and Exchange Commission take the lead on this process rather than the FSOC, the Financial Stability Oversight Council, or say the Fed, which comes basically more out of a banking heritage. Do I have that correct?
Yes, I mean, we believe that the SEC is the right regulator to be looking at this. They have a 75-year history of effectively regulating mutual funds and fund advisors, and we believe that they have the expertise and the understanding of funds, and this is where it belongs. Financial regulators have been looking at ways to make sure that their rules are providing financial stability, and we believe that this is just part of that overall review, and we believe the SEC is the right place to be doing that.
All right, so you're thinking pretty much that this is a good thing for individual investors, but are there any unintended consequences that could come out of all of this, these new rules?
Well, it's hard to know. Like I say, we really don't know what the rules are. I think we'll have a better idea once the SEC proposes something and allow us then to look in depth at what they're proposing to see if there are any negative effects and whether or not there are more effective or cost-effective ways to actually addressing the concerns that they have and in gathering the information that they believe that they need.
Brian Reed is the chief economist at the Investment Company Institute. Brian, thank you.